Imagine this. It's 9:47 p.m. You're in bed. Your phone lights up. Transaction alert. $1,284.63 charged to your joint credit card. Your stomach drops. You didn't swipe that card. You slowly turn your head and look at your spouse. Now, here's the uncomfortable question. Is this a money conversation or like the beginning of resentment? Because here's the thing. Nobody really talks about this. Most financial fights in relationships don't start with cheating. They start with credit cards. And the worst part? You both thought opening a joint credit card was, the responsible adult thing to do. Yeah, that's exactly how it starts. My name is Ian, and I spend way too much time thinking about how everyday financial decisions quietly destroy people's wealth. If you're someone who wants a strong relationship but also wants financial independence, someone who doesn't want money arguments slowly, quietly draining your peace, make sure to subscribe and give this a thumbs up if it helps you. Today, we're talking about something that sounds harmless, even loving, but could quietly cost you thousands, and more importantly, control. So let's just get into it. Somewhere along the way, we were all kind of sold the idea that if two people love each other, everything should be shared. Toothpaste, streaming passwords, location, and of course, credit cards. It sounds unified. It sounds mature. It sounds like, yeah, we're in this together. But here's the thing. A joint credit card doesn't symbolize unity. It creates shared liability, and those are not the same thing. When you open a joint credit card, the bank doesn't see romance. They see two legally responsible adults who are each 100% liable for the full balance. Not 50%, not whoever spent it, 100%. If the balance hits $12,000, you are both responsible for the entire $12,000, even if you didn't spend a dollar of it. You might say, well, we trust each other. Yeah, trust doesn't really eliminate human behavior. Stress changes behavior. Job loss changes behavior. Mental health struggles change behavior. Impulse spending changes behavior. And when spending becomes shared, accountability becomes blurred. If you have your own credit card and the balance creeps up to $3,000, you feel it. You think twice before swiping again. But if it's a joint card, you think it's for us. You rationalize. Your partner thinks, we'll sort it out later. Slowly, quietly, the number grows. 2,000 becomes 4. 4 becomes 7,500. No single purchase feels catastrophic, but together it becomes a problem. This is called diffusion of responsibility. When two people share ownership, each feels slightly less accountable. It's the same reason group projects fall apart. Everyone assumes someone else is managing it. Now, let's bring math into this. If your joint card has a $15,000 limit and you're using $11,000, that's roughly 73% utilization. Credit scoring models heavily weigh utilization. Cross 30% and your score can dip. Cross 50% and the impact grows. Cross 70% and lenders start seeing risk. So when you apply for a mortgage or finance a car, your score might be 40 or 50 points lower, not because of something you did personally, but because of shared spending. That lower score can mean a higher interest rate, and over the life of a loan, that can cost tens of thousands. People say, we're responsible, we only use it for shared expenses. Sure, at first, but life doesn't stay predictable. Car repair? Swipe. Last minute trip? Swipe. Medical expense? Swipe. Holiday shopping? Swipe. Because it's joint, it feels less threatening. Convenience is expensive. The easier it is to spend, the harder it is to control. And joint credit cards double the emotional permission to overspend. A couple opens a joint card for household use only. Month 1, perfect. Month 3, dinner out goes on it. Month 6, a laptop. Month 9, a vacation deposit. Now the balance is $9,800. No one meant for it to happen, but it did. Because when ownership is shared, discipline must be doubled. And most couples don't double discipline, they double flexibility. Let's say the balance hits $10,000 at 21% interest. Paying $300 a month could stretch for years and cost thousands in interest. Debt adds pressure. Pressure adds tension. Tension turns into arguments. And arguments about money feel personal because money represents time, effort, sacrifice, and security. Suddenly, it's not about the card. It's about, you don't respect our goals. You're controlling. You don't trust me. A financial tool becomes a relationship weapon. Marriage works best when both people feel autonomous but aligned. Think of it like two drivers heading to the same destination in separate cars. You coordinate, you communicate, but if one car breaks down, the other keeps moving. When you fuse everything, especially credit, you eliminate that buffer, and buffers protect stability. If separation happens and there's $18,000 on a joint card, the bank doesn't care who moved out. Both names are on the contract. Missed payments hurt both credit scores, and repairing damaged credit can take years. Financial independence inside a marriage isn't selfish, it's strategic. You can share goals, savings, and investments, but revolving debt should be tightly controlled. A smarter structure is simple. Keep individual credit cards and open one joint checking account strictly for shared bills like rent, utilities, groceries, and insurance. Each person transfers a fixed amount monthly based on income percentage. Transparent, predictable, controlled. After shared expenses are covered, personal spending stays personal. No guilt, no monitoring, no hidden resentment. If one person overspends, the impact stays contained, not contagious. A joint credit card is essentially an open-ended, co-signed loan with a swipe button attached. I'm not against partnership, I'm against unnecessary financial risk, because protecting your credit score protects your options, and options equal power. Zoom out. This isn't about plastic, it's about psychology. We were conditioned to believe merging finances equals merging love, but symbolism doesn't pay interest, structure does. Love doesn't manage cash flow, discipline does. Spending habits are deeply personal. One person grew up with scarcity and saves aggressively. The other grew up with abundance and spends freely. Put those scripts on one credit line and friction is inevitable. The saver starts watching statements. The spender feels judged. One becomes controlling, the other irresponsible. A good financial system should reduce conflict, not magnify it. Rewards points don't fix this. If you're carrying a balance at 20%, your 2% cashback isn't winning. Couples who maintain partial financial independence often report less anxiety because autonomy reduces fear. When you know you can stand on your own, you don't operate from panic. Financial panic leads to bad decisions. Bad decisions lead to debt, and debt leads to stress that leaks into everything. Instead of asking, should we get a joint credit card, ask, what structure makes us stronger long term? The couples who thrive aren't the ones who merged everything blindly. They're the ones who built guardrails. Guardrails create accountability and protect credit, and protecting credit protects opportunity. 5 years from now, you may want to start a business, invest, or take a career risk. Clean credit and controlled debt give you flexibility. High revolving balances limit it. Banks design credit cards to profit from impulse, emotion, and convenience. When you double the users, you double the variables, and volatility plus high interest equals profit for the bank, not you. If you want to operate as a team, follow this framework. Shared vision, shared essential budget, separate discretionary spending, zero revolving consumer debt. You don't need a joint credit card to prove commitment. Commitment shows up in communication and consistency, not shared APRs. If you already have one, don't panic. Evaluate. Look at the balance, the interest rate, the utilization. Is it helping you build wealth or slowing you down? If it's slowing you down, create a payoff plan and eliminate it aggressively. Don't drift. Money problems rarely explode overnight. They accumulate silently, one swipe at a time. Wealth is built through disciplined systems, not emotional decisions. The couples who win financially are intentional behind the scenes. Protect your credit, protect your autonomy, protect your relationship from preventable pressure. Financial peace is one of the most underrated forms of intimacy, and that peace starts with structure, not symbolism. And remember, love is powerful, but systems are protective. You can care deeply about someone and still build financial boundaries that protect both of you. That's not cold, that's mature. The goal isn't just to make money together, it's to keep your peace together. Build structure, eliminate unnecessary risk, stay intentional, and don't let convenience quietly cost you control. I am Ian, don't be broke, see ya.